Well, let's welcome in Devina Mehra, who's with us, founder, chairperson, and managing director at First Global. Devina, good morning. Great to see you, as always, here on CNBC TV 18. Now, let me just start by asking you, Devina, you know, the basic, let me start with the premise. You'd typically you would not do well by doing what everybody else is doing. And that is the reason why, I mean, these calls for buy stuff which no one else is buying and sell a little early, and that's good if there's too much euphoria. I know it's a tough one, but my question is actually simple, although I'm prefacing it with all this. Which are the areas which are absolutely unloved, which you think will do well as we peer into 2026, and vice versa?
See, that's difficult to say because, I mean, you cannot be contrarian for the sake of it. I mean, that does not make sense. I mean, the only thing where we think our system help is that it signals it a bit early. So, for example, industrial machinery, capital goods, we got in October 21. Most people discovered it a good 2.5 years later. So that sometimes happens. But I wouldn't say that this, I mean, in this current rebalance, one area which was at least unloved by us, where we have added is the energy or oil sector. So, that's been the kind of new thing which has come in, and I don't think we had any weightage there. So that is one thing which has changed this quarter. Most of the others are often not that dramatic changes. IT little went from large cap IT to mid cap IT. But other than that, some of the themes have run for a while for us, like pharma, healthcare, auto components. Of course, pharma did not perform that well in between. So I think that has begun to change. PSU banks is something we added through this year. So that is, again, by now a discovered theme, you can say. So broadly, that would be, or as I said, some themes have run from last year. FMCG has been built up over this year, again, liked more and more by our systems as time went by.
Devina,
and I don't get into a very high risk sector just with the hope that it might outperform. Usually outperform. Yeah. I mean, there are enough stocks usually in a market that outperform. Of course, I mean, I heard what you said at the tail end that in the index, the things look much better than they do in individual portfolios. So this has been an unusually narrow market. It has broadened a bit since August. August was, I think, one of up to August was like the up move was one of the narrowest I've seen, where only about 10-15% of the stocks outperformed. Probably even, I think at one point it was even less than 10%. Whereas, I mean, just to give you a norm, I mean, the norm is about 40% outperforming. Even when it is 25% outperforming, we think, this is the market is narrow. And this time it's been very narrow. And even now, there are a whole, I haven't seen the last numbers, but if you look at stocks down 20% plus or 25% plus, that is still a very large percentage of the stocks.
Devina, hi, morning. Good to have you with us. So you're someone who's always been a strong advocate for diversification and global diversification as well. So just wondering, Amin, if there is any change in thought in terms of the global part of your portfolio, looking at everything that's happening in the US. I mean, it was almost US equities were unrivaled, unchallenged, but now there's this whole AI debate going on, bubble, not so much a bubble, etc. So have you made any changes there with respect to your US allocations?
Yeah, so as I always say that US is not the world. So this is what other thing which I keep telling people, that don't think you have globally diversified just because you have bought an NASDAQ or S&P. And of course, there the market has been extremely narrow. I mean, it has been just the tech. In fact, global equities also, if you see the entire move this year, something like 75% has been tech. In US, it has been just that one handful of stocks, the Magnificent Seven. But besides that, also, I was looking at the categories of stocks that have done the best in NASDAQ, and the companies with no revenues and profits have done the best. So either with no revenues or no profits, both those filters, those stocks have done extremely well. So, but that is that's a sign of danger. And even before this, if you'd asked me last year also, I would have said that the US has outperformed for well over a decade. And at some point, that outperformance has to end. And I think President Trump, all the things that he did also is kind of hastening the end of that US supremacy in many areas. And also, you talked about the AI bubble. Yes, I mean, to me, it is always, I talk about this, that when a new technology comes in, which particular thing will succeed, how long will it take to succeed, which company will succeed, and even if the company succeed, will you make return on capital? That is the real question in all this spending on AI. I mean, just to remain in the race, you have to keep spending. You have to keep spending on, of course, the data centers, which is real estate, fast depreciating assets, and also a lot of power. But even to get people, I mean, I've heard of 100 million salaries and 500 million salaries. So you have to run just to keep in place. And you will, I'm not sure you will get anything like the return on capital. People might use it, but when schools and colleges were shut, many of these AI models, their usage dropped by 60, 70%. So it's been used by students for assignments, whether they were to pay. And still, I mean, you are a long way from the enterprise segment trusting the AI systems, because there is so much of hallucination, and that famous Deloitte thing in Australia, when so much of the report generated by AI they found it was made up, right from court judgments. It had made up a whole lot of things. So there are many, many question marks, and basically, it ultimately, if you look at in financial terms, whether the return on capital will come on all the money that's going in. So there's definitely, something which doesn't make financial sense. And eventually, if something doesn't make financial sense, the market wake up to it. Then there's also a lot of debt being raised by AI companies, which is like, again, one other red flag.
All right. Hi, Devina. Good morning. Good to hear your thoughts as always. Let's talk about what you said you recently added. Oil and energy sector, right? Could we drill down a little bit into this? What have you added out there?
Basically, oil marketing companies. So that's mainly where it is, because, I mean, the crude oil prices are not that high that you would go to that side, the other side.
All right. So you like the valuations. Your crude oil prices remain suppressed, and I think refiners they have a smaller portion of that in their mix.
Yeah. But this was a sector where we practically had no weight. So I mean, it's not that we have gone hugely overweight or anything, but that's where we have added.
There was this, I keep, by the way, another way to measure, but Devina is talking about oil marketing companies here. It just struck me. This one stat about, and Hormuz did that link, if you remember last week, how big is NVIDIA? NVIDIA is larger than the entire US energy sector combined.
Wow.
Right? So that's the other one. And to Devina's point, and Devina, looks like it's Sanjeev Prasad of Kotak put out that note, and I thought that note really, the title of that note really, you don't need to read the note. I mean, the title said it all. It said low ceiling, high floor. That's his description for the market here in India. Low ceiling, high floor. So you're basically stuck, very, very narrow. And I think what you're saying somewhat echoes that broadly.
No, I mean, I see, the markets will always frustrate you. They will never do what you want it to do and when you want it to do. But always remember that sentiment is a contraindicator. When there's excess buoyancy, as there was for the first 3 quarters of 2024, when everybody thought like 30% compounding was there for the taking, is when you should be cautious, because studies around the world show that when there's that buoyancy, the next period returns are below normal, as what happened in the last whole summer. And when you are questioning yourself, what's the point of being invested in India? And, should I stop my SIPs? That's when the next period returns are above normal. I mean, that's the data around the world, from Brazil, Portugal, India, US, wherever, whichever market you track it is the same. So that is the whole point, that you're keeping control of your emotions and remaining invested when those questions come is really the superpower.
Okay, all right. Devina, we'll leave it there. Thank you very much for joining us. Good speaking with you here on CNBC TV 18. Appreciate it very much.